Hello, this is Will Allen with Sentara Capital. The stock market has recovered roughly 50% of its decline. This despite the fact we have seen awful economic data and companies have been withdrawing their 2020 guidance. We look to make sense of everything here. Let's go. So what have been some of the factors behind the stock market's strong recovery off its March 23rd lows? The first thing is we have had a lot of companies here in the U.S. and around the globe, pharmaceutical and biotech companies working basically round the clock for medical treatments, whether that be antivirals or vaccines. We've had some positive developments. Just last night, a report came out that Gilead's drug, remdesivir, has had very good results in Chicago. We need more data. But the bottom line is, over the last few weeks, we've been hearing news coming out that there are some promising developments taking place. So this has really been helpful because this would all of these medical developments could be important in limiting the outbreak in the future, in the fall, next winter, etc. Also, we have seen economies start to reopen around the globe. South Korea, Taiwan have been reopened for a while now. You've just seen European countries starting to reopen. Austria, Denmark, Spain has started to reopen, and Germany next week will begin to open some schools and small businesses. And then yesterday we heard that in the U.S. starting May 1st, every state will be different depending on if they've been harder hit or not, but you will start to see businesses reopen, people coming out and able to do more things throughout the month of May. So that's very promising. Again, we got to be a little careful here because as people get out, we have to make sure that there are not, a second wave of infections. But I think a lot of people are optimistic that we can start to see businesses get back up. And then the last thing, and maybe the most important thing that has, I think, been very helpful for the markets has been really an unprecedented continuing actions that the Federal Reserve has taken. Going back a month or so ago, they cut interest rates to zero. They said they were going to start buying Treasury bonds. But over the last month, they started buying investment-grade corporate bonds. They started lending money to states and municipalities, Main Street companies. And then also, as of last week, they announced they were going to start to buy junk bonds, which we're not big fans of. Not sure the Fed should be dipping down and buying high-yield bonds, but that's what they're doing. And all told, we're talking about $6 or $7 trillion of liquidity and funding to the markets and to businesses by the Federal Reserve. This has never been done. Even in the financial crisis, this has far exceeded anything they have done there. And they've been clear they want to head off a Great Depression-style event, and that's the reason for their actions. But when you take a look at the medical developments, economy starting to reopen, and this incredible action by the Fed, all of that has given fuel to this stock market rebound. While the stock market has had a really strong recovery so far off those March lows, a couple things are still taking place out there that we need to be aware of. Oil broke below $18 a barrel today, and typically you want to see oil start to rebound in anticipation of increased demand. That just hasn't happened so far. We have a lot of supply out there, but the bigger problem is just around the globe. Demand is down so significantly much. We'd like to see oil stabilize and start to go higher, $18 and headed lower. That's not good news on the oil front. Also, the 10-year Treasury bond, the yield on that today is at 0.60% here in the U.S. And that, again, you want to see start to go higher. When there's a lot of panic, a lot of chaos, you can expect that rate to go lower as investors rush into bonds, pushing those prices up and the yields down. But so far, we have not seen a rotation out of treasuries. A lot of money still going into the 10-year treasury bond. And there's a lot of external factors. We know the Fed's buying a lot of treasury bonds. But that being said, we'd like to see that rate start to go higher as bond investors begin to forecast and hope for better growth in the future. And again, if they're anticipating that, rates should go higher. In addition to that, stocks here in the U.S., the market has been very bifurcated. Tech stocks, the stay-at-home stocks, healthcare have done very well, but small cap stocks are still down 30% from where they were a couple months ago. Bank stocks are down 30 to 40%. Those are a couple categories that we'd like to see start to rally. They're a lot closer to Main Street, if you will, and small businesses. And when they're down so much, that still casts some doubts on the path out of this deep recession. On that note, we have big corporations and we have small businesses, which each make up about 50% of the jobs in this country. And one of the things that were in the Congress's stimulus bill was the Paycheck Protection Act, which basically allocated about $350 billion to small businesses. And that has been exhausted. That hopefully will be refunded very soon or refilled very soon, because one of the concerns we had was in that $2.2 trillion bill that only 17% of that money went to small businesses. You know, large companies have a lot of accesses to capital, and some of that money also went directly to consumers in direct payments. But small businesses are the ones that we're most concerned with here. Most of them do not have funds to get through months and months of being shut down, not having any revenue. They're going to need more funds, and even with more funds, it still is going to be a tough road back for many of them. We got to watch this sector very closely because, again, the U.S. consumer, who's been doing so well for the last 4, 5, 6 years and getting better and better as the years have gone on, they're hurting a lot right now, and I think there's still legitimate questions as to how quickly they're going to bounce back. We've had 22 million unemployment claims just in the last 4 weeks here in the U.S. We expect that number is going to grow in the coming weeks to over 30 million people lose their jobs. A lot of these people are going to get back jobs pretty quickly if things can rebound, but there's still going to be a lot that the jobs don't come back. And so again, this bears close watching because the strength of the U.S. consumer is very important to growth, not only here, but around the globe. Looking ahead over the next couple weeks, we will continue to get the heart of earnings season. And we know that the market has basically written off 2020 earnings. Many companies are just taking their guidance for the whole year completely off the table. And the stock market has been okay. Again, I think the market's looking ahead to 2021, even though there's still a lot of questions there. And so you have this economic data that's coming in that's really tough. This last week, you had retail sales, industrial production, housing starts that were at historically bad levels. And the market's basically overlooked that. And I think the market's saying, look, we know this data. We know the earnings for 2020 is going to be terrible. We want to look past that, which again is okay, except for the fact that I think there's still a lot of questions about economies restarting. How quickly will economic activity return? We talked about small businesses a little earlier and all their employees. So we want to continue to hold quality. We have some extra cash. There will be further pullbacks in the market. This is not going to be a straight line back to where the markets were in February. The economic pain is just too great for that. And again, holding quality companies, quality has dramatically outperformed the indices and companies that don't fit into that criteria. Your large companies with good balance sheets, strong growth, companies that benefit from more people being online or working from home. And we think that will continue in the longer run. But regardless of what takes place, we'll be here, we'll be watching. Thanks for paying attention.